Now, with 476 billion naira hitting the system through maturities, the CBN conducted an auction on Thursday, mopping up 500 billion naira of liquidity. Bankole Odusanya, fixed income trader at UBA, joins us now to review Nigeria's fixed income and FX markets and to forecast what next week could bring. Bankole, thank you for joining us today.
Thank you, Esther.
We understand that the T-bills market was quite active today. Talk us through overall market performance.
Yeah, on the back of the OMO issuance that we had yesterday, rates dropped from 14.3% to 13.99%. It was expected, but not at that level. So what happened was that only 470 billion was sold. A lot of the amounts that were subscribed for were not sold by the central bank. So what happened was that at the interbank market today, most surplus units who had a lot of liquidity and order to fill for their customers came to fill those orders and demand in the market. It was a bullish market all through today. Towards the end, there were some profit taking, and then there were some houses who would, like to just moderate their positions. But overall, it was bullish, and we expect that to continue into next week. The reason why I was saying this is because there may not be another OMO until Thursday. For those who did not go into that market to cover today, they were expecting another OMO to put in another bid at these levels or slightly lower. So basically, we expect this bullish trend to commence next week again, because the system is still liquid at about 500 billion, which is quite high.
Okay, so now let's move on to inflation. Inflation came out yesterday. It's down almost 1% to about 13.34% or thereabout. What's your view on inflation for the rest of the year? And how low do you really see inflation going? Do you think that could push the MPC to finally give us that cut that they've been forecasting and signaling?
Yeah, the MPC have always considered inflation and FX stability as key issues in making their pronouncements. We do not see a major, huge dip going forward, because at about this time last year, the I&E market was opened. That's April 24, 2017. And if you look at the impact of that market on the base prices that have been used to compute these inflation prices, the CPI, you would see that prices steadied, and then imported costs, of inflated prices, which were due to high FX prices as at then, were moderated. So going into May and June, we see some more stable CPI figures. We do not see a huge drop, that is comparing this year figure to last year. The reason why we had this huge drop in prices, growth in prices, is simply because of the base year figure, which was the year-on-year, looking at 2016 to 2017. But looking at 2017 to 2018 now, we expect some level of moderation, basically.
Let's talk yield curve movements. We've seen a range of between 12.3% and 13.5%. And now with inflation, the latest inflation numbers down at 13.3%. How do you forecast the range of yields going forward for the T-bills and bond market?
Okay, upon the drop of stop rate at the OMO market yesterday, we've seen a further drop in the rates at the secondary market, both on the treasury bills and the bond side. On the bond side, markets opened at about 13.5 levels. We've seen rates drop to about 13.35, and then on the bills, for bills that traded at 13.5 as at yesterday, they traded at 12.9, 12.85 levels today. And for those that were already short-term bills that were already below 13%, they simply just moved down to 12.5. We expect this to continue into next week because of the liquidity we've spoken about. And then the view that rates will continue to trend downwards, because the central bank, unlike last year, has changed its mode of mopping up liquidity. All through last year, the frequency of OMO was quite high, with was seeing OMO issuances about 3 to 4 times a week. But this year, we're seeing them come in to mop up only on Thursday. Okay. So basically, we expect yields to continue to trend down marginally.